This stock on the screen right here had a rough day on Friday, dropping nearly 30% in a single trading day, shedding a ton of value off of its overall market cap, which now sits at around $8 billion. What caused this crash? What stock is this? Am I buying this stock? Is this a good buying opportunity? These are the questions I'm going to answer for you guys in today's video. Before we go any further, guys, take a guess in the comment section down below as to what stock this is. And if you get it right, I will heart that comment. Try not to cheat. But either way, while you're down there, smash that like button as well, and let's get into it. So the business we're discussing today is called Alteryx, ticker symbol AYX, and they're a software as a service, or SaaS company, which just reported their Q2 earnings. To put it lightly, investors were a bit spooked with these results and forward guidance. But before we get any further into their actual financials and how they did in the quarter, let's understand the business and let's figure out if this is a stock or a company that actually makes sense as an investment. Does it actually have potential to be a multi-bagger stock in the future? I think by understanding the business, we'll get a better idea of that answer. So quick overview of the company. They were founded in 1997, which is more than 2 decades ago, and have been public since 2017. So this wasn't really a get-rich-quick overnight kind of stock where they built a business quickly and try to go public as quick as possible. No. These guys took their time building the business out, and they went public when they felt the time was right, and that in itself is a good sign. They're a fairly small business with $418 million in revenue in 2019 and 1,500 employees in total, but they currently have around 6,700 customers. Now this chart on your screen here may be a bit daunting, but just try and stick with me here. At its core, Alteryx provides a platform to do data analytics, specifically in Microsoft Excel spreadsheets. Using their analytic process automation, they facilitate data analytics and data science via a code-free and code-friendly platform, so anyone can really use this. Then they automate the entire analytic and process pipelines in the context of the desired business outcome. Finally, they empower citizen data scientists to become self-service digital workers. So essentially, they take the boring old spreadsheet data that's usually overwhelming and messy and not really useful for an organization, and they organize and present it in a digestible form, which helps businesses and employees become more efficient. The results are generally 2 key things: an improvement of business outcome, like the top line growth and increased bottom line returns, and it also results in improved workflows, resulting in more efficiency throughout the employees of the company. Trying to work with and use analytics manually within a business wastes a lot of time, and time is money. Billions of hours a year is wasted within spreadsheets trying to do simple tasks, and many of you watching who work for large organizations like banks, for example, can probably relate to this. The processes are just so out of date. Because of all this, it costs these companies billions of dollars in wasted time. In fact, they estimate around $60 billion is wasted on analysts doing repetitive manual work in spreadsheets. So Alteryx was like, there must be a better way. So they went out there, they built it, and now it's a very successful business here because of what they've built to help businesses manage their spreadsheets more efficiently. They did this through their API platform, and this right here is how they have helped businesses change the way they analyze data and become more efficient while simultaneously growing and improving their financials. And guys, the market that they're playing in is huge. It's a $49 billion market, but it's growing rapidly with the amount of new data created every second. So I would say this is a pretty exciting space to be in, and Alteryx is at the heart of it. Now remember, they said they have over 6,700 customers. Well, they aren't your mom and pop shops. These are legit customers. Names from IKEA to Kellogg to Procter & Gamble, Netflix, Visa, Facebook. The names go on, and these are all companies that use their product and see the benefit of their product. In fact, they back up their claims and provide us some examples here of how they're able to actually help businesses save money and earn more money. They helped a retailer increase their sales by $1.5 billion. They helped an airline company earn $80 million more. And we all know, guys, every penny counts right now for these airline industry companies. They helped increase efficiency. They helped upskill workers. They all around made businesses more efficient. Now, at the end of the day, Alteryx is a growth company, and that's the reason that investors do find the stock appealing. And the business is focused on 5 of these key pillars, from international expansion to growing their partner ecosystem. This business has a plan in place to keep growing as a company in this world that is more and more reliant on data. So that's kind of the rundown of the business, and I think that they do an excellent job of really showing investors like us how this company provides value to their customers. In a sense, yeah, you pay for their product, but the value that the product gives you back saves you so much money that these customers just continue paying that subscription fee. But now guys, all of this is great, fine and dandy, but why did the stock crash 30% in one trading day? Clearly there was something that went wrong. Clearly there was something that investors did not like, so let's digest that right now. Well, they reported their Q2 earnings and they actually had a pretty good quarter. EPS beat by 16 cents and revenue beat by 2.09 million, but it was up 17.3% year over year. So looking at this, pretty strong quarter, no complaints here. The issue that investors had though was with their guidance and forward-looking statements. Here they state that they assume significant headwinds will continue through 2020 and there will be uncertainty around new businesses and renewal timing or billing terms, particularly with customers in these highly impacted industries. In other words, there's uncertainty if they will actually get many new customers, if any. There's also uncertainty if their existing customers will continue paying them or not, or go ahead and renew their subscription or cancel it altogether. For a SaaS business, this is kryptonite because if customers cut their subscriptions, the revenues for the company can dry up overnight, and this is a very real risk that Alteryx is facing right now. Along with this, they also gave some outlook for Q3 and fiscal year 2020, and both are expected to see growth, but lower than initially expected. In fact, for 2020, growth is expected to come in at around 10 to 11%, which is low for this kind of business where investors were expecting much higher growth initially. The plus side though is that the annual recurring revenue is expected to be around $500 million at the end of December 2020, which would be an increase of 30% year over year. Now, another shock to investors was the big loss that they suffered this quarter. The company actually just hit profitability in 2018 and they sustained that in 2019. So now with this $35 million loss, it raises the question if 2020 will be a profitable year or not for the business. The loss was a result of lower subscription revenue coupled with an increase in spending, and you can see that they were aggressively spending this quarter on marketing, R&D, and administrative costs. The interesting part is that if they held back on these costs and say they spent the same amount as Q2 2019, their net loss would have been around 12 million versus the posted 35 million. So it is a big difference here, but still a loss at the end of the day. Now, for any business, any investment, the customer base is very, very important because that's how they earn their money. But for SaaS companies, it's pretty much the most important thing. If they don't have customers on their subscription model, they are going to struggle to earn any sort of money here. Here we can see customer growth is still steadily increasing, up 27% year over year and up 70% from Q2 2018. So the growth is still here and still strong. Another very interesting part of this business is that because it's primarily software, they have sky high margins. They have over 90% gross margins, but a lot of it gets eaten up by marketing because they are so small and need this to keep growing. But the logic is that eventually over time, as they build a solid customer base and their brand is well known and word of mouth really gets out there and they're able to really grow that way organically, they'll be able to scale back on marketing and then enjoy higher profits due to their business model. You can clearly see that their long-term targets are in line with this sort of thinking, and this makes me bullish on the business because if they can achieve this, it would be a very high profit company with low overhead costs. Now, of course, comes my favorite part of the video, the balance sheet for the company. The assets here are looking strong, $128 million in cash and a lot of money in short-term and long-term investments. Their current assets sit at $872 million and total assets sit at $1.3 billion. And what I like is that their goodwill portion is very low, so most of these assets are tangible. On the liability side, it's not looking too bad either. $224 million of current liabilities, which is manageable, and total liabilities of $906 million, with most of it coming from convertible senior notes, which added around $643 million in liabilities. And if you're not familiar with what senior notes are, they're basically bonds that must be repaid before any other debts of the company. So really the bottom line is just another form of debt. Now, I'm not too thrilled with this balance sheet. I would say it's okay. They have more assets than liabilities, which is good, but this could very easily turn into a big mess if their subscription revenue starts drying up. Now, if we add up their cash, short-term investments, and long-term investments, it adds up to around $974 million, but the bonds alone are $643 million, so it would leave them with around $330 million in cushion after that's paid off, if worst comes to worst, which isn't all that bad, but it isn't all that great either. Nonetheless, they do have the cash and assets to cover themselves if times get tougher from here on out, and their customers, say, decide to pause payments or cancel subscriptions. So don't be surprised, guys, to see that cash balance start to diminish for the short term, at least to the end of 2020, as the company is most likely going to see more losses in the coming quarters. Now, does all of this mean that Alteryx is a dying company and, there's no chance this company can ever come back? Absolutely not. I think what we're seeing right now is short-term pain for the business. However, if they don't navigate this properly, they could permanently lose a lot of their customers here, and that could have long-lasting effects. I would say that maybe a 30% sell-off could be seen as irrational by some investors, but on the flip side, it's also possible this is somewhat warranted and there actually could be more downside here. If we look at their fiscal year 2020 guidance at the beginning of this year, prior to everything going down the drain, the company estimated around a 33 to 35% growth year. Now, guys, that's revisited down to a 10 to 11% growth year. So it's quite a significant hit that the company will be taking in 2020. And as a result, the stock adjusted for this. Investors are always looking at the forward outlook for a company, and when growth gets slashed this drastically, the stock is also going to follow. The stock price when they initially gave this 2020 guidance was around 140, meaning investors were willing to pay that premium as long as we saw a 33 to 35% growth. And now that it's down to around a 10 to 11% growth, the new price investors are willing to pay is much, much lower, with the stock now sitting at just over $120 per share. Now, if I'm being honest, even $120 seems like a premium here for this business, considering only a 10 to 11% growth, and I will personally be watching to see if this comes down to about the $100 mark. 120 may seem like a good price for a long-term hold, and short-term fluctuations shouldn't matter that much for you if you have a long-term view, especially after a 30% correction. But there is real uncertainty for this business for the foreseeable future with their customer base and their growth numbers, so you have to be prepared to weather the storm of volatility here if you choose to enter the stock at these levels. It may not be a bad idea to open up a position here and kind of average down if the stock price does go lower, if you truly love the business and understand this business. But I'm going to be honest, this is a pretty complex business. Yes, a high level, they just go out there and they provide better analytics for spreadsheets. But understanding the nitty gritty part of this, that's kind of where I think most investors lose it. They don't really want to learn about that or pay attention to it. But if you're going to be buying this company, especially when it has such negativity around it right now, you need to have a good understanding of that. Let me just put the situation out there. Let's say you buy the stock today at 120, right? You're happy with that, 30% discount, everything looks good. What if the stock price trickles down and we get to $100 per share in about a month? Are you then willing to add more to your position? If the answer is no, then maybe this is not the stock for you. But if the answer is yes, you're excited to add more at lower prices, then this could be a very good opportunity for you over the long term. That's how I always look at my investments. I try to look at like a worst case scenario or like a worser case scenario where, I buy the stock today at this price, but if it drops another 10, 20, 30%, am I still willing to buy? And if the answer is no, it's probably not an investment for me then. The other kind of gripe that I have with this company is that their focus is very niche. Their focus on spreadsheets, and that doesn't really excite me. I know that some investments, they don't really have to be exciting, but guys, this is supposed to be a high growth company. This is supposed to be a company that's kind of revolutionary, SaaS company, all this kind of stuff. It just doesn't excite me. The business model is not that exciting, and because of that, I may actually be sitting out this one until we see possible much, much lower prices. This does not mean it's a bad investment here today. This does not mean that the stock price can't go up from these prices. I know a ton of you guys, especially ones in my VIP membership group, are buying the stock right now. And long term, this could probably be a very strong winner. But over the short term, I do suspect we will probably see more volatility in the stock, and we may actually come down to test that $100 price point in the next few months. Now guys, I do want to leave you with some positivity here around the stock, because after all, this is positive investing. A bunch of analysts actually came out after the earnings and revisited their price targets, and for the most part, consensus is still strong, around 40% higher than where we are at today. This should be taken with a grain of salt, nothing more, but is a bright spot here for a potentially undervalued stock where analysts do see some good upside in the near future. Either way, let me know what you're doing with the stock. Are you buying shares? Are you selling? Are you one of the people that sold out here on this dip? Or are you just continue holding on to your shares if you already had the stock prior to the dip? Let me know. I'd love to hear from you in the comment section down below, guys. But either way, thank you so much for watching. Don't forget to invest positively. I'll see you in the next one. Peace.